Good afternoon. Thank you for joining us for Adelaide Capital's first webinar with Kolibri Global Energy, which trades under the ticker symbol KEI on the Toronto Stock Exchange. With us today from the company is Wolf Regener, President and CEO, as well as Gary Johnson, CFO. Being you are new to the Adelaide network, I think it would be helpful to provide some background, your current story, and there will be time for Q&A. Please input your questions in the Q&A box. As always, the presentation may contain forward-looking statements. Welcome, Wolf and Gary.
Well, thank you. Thanks for having us. And thank you for everyone for joining us today. We're going to go through this story. Actually, I think we have a pretty simple story, so it shouldn't take too long. My goal today is to demonstrate to you that Kolibri is a good, solid company, has a great balance sheet, has cash flow that is growing rapidly, has an excellent asset base. I'll also show you why we feel we are currently quite undervalued compared to our peers and the steps we're taking to rectify that undervalued situation. I'll start with pointing out that we do have some forward-looking information, some forward-looking slides here, the details of which you can read on our slide 2. And then we have a page of disclaimers followed by 2 pages of disclaimers relating just to the non-GAAP measures that we and others in the industry routinely use. Lastly, I'll point out that our adjusted funds flow is very similar to adjusted EBITDA for those of you in the US. I'll start with management here. Myself, I've got 36 years of oil and gas experience in operations, finance, M&A, land, and more. Companies I've run have survived numerous oil industry downturns and sold a number of projects in my career. And so I think I've got a good background on multiple strategies going forward here for the company. Gary Johnson, our CFO, is here with us, so I'll let him say a little bit about himself.
Hi, everyone. I'm Gary Johnson. So yeah, I'm a CPA with about 30 years of experience, most of that in the oil and gas industry, including a stint at Occidental Petroleum. So, and then I've worked for other companies as well. So I'm excited to be part of the presentation.
Greg Presley, I'll move on, is our senior engineer. And he's worked with us through this project, through the learning curves of improving our drilling and completion through this project. So we've gotten better and better at completing wells and making better wells. Alan Hemme, our senior geologist, has been doing a great job for us, has been working in this field for us since the beginning. Moving on to our board of directors, David Newhouser, our chairman, Eric Brown, Leslie O'Connor, and Evan Templeton. We've got basically what I like to say is multiple things covered where we have a good, strong group and varied experience. We have capital markets experience with David as well as Evan, accounting and audit experience with Eric, who's head of our audit committee. We have reservoir and economic evaluation experience with Leslie. And Evan also has risk evaluation experience due to his years of high yield and leverage loan market experience. Moving on to the company overall, we've got, as I mentioned, financially stable. We're low debt. We took our debt from 30 million down to about 16 million. We really started drilling wells this year again after taking a hiatus for about 3 years. We have a large ratio of proved reserves, small on the PDP side, growing, but big on the proved developed or proved undeveloped side. Most of it is in the PUD category when you see overall our reserves, 57% plus 7% of the PDPs. And that's one of the reasons that we feel we're undervalued is that, during downturns, people value companies on PDP reserves, not on PUDs. And that's changing obviously now, but it also shows, or we're hoping to show you how we can transform these PDPs into more PDPs by converting our PUDs. And that we're low risk in what we are drilling here and how we've drilled enough wells to evaluate what we have and where we can go forward here. We have strong corporate governance. We have Netherlands Sewell doing our reservoir engineering and KPMG that does all of our audits. The company profile overall, production, as I mentioned, is about 75% here is oil. So a good portion of what we have is oil. It'll go higher than that in the wells that we're drilling right now that are about 80% oil. We have a couple areas of the field that are a little bit gassier, but we're focusing on the areas that have more oil as a percentage, so more in the 80% range. But the biggest thing you'll see is last year our Adjusted funds flow was about 6.5 million, as you can tell right here. And our forecast for the year is around 26 million. So big growth. As I mentioned, we hadn't drilled in about 3 years. So now we're starting to drill. Our production, about 1,900 BOE a day at the end of second quarter. And our forecast is to exit the year with about 2,700 BOE a day. The valuation wise, when you looked at our proved reserves at the end of last year, so this is prior to our drilling these wells that we've drilled, our proved reserves were 360 million. And that's based on oil prices of $68 to $72 for the first 6 years or so. Obviously, even with the downturn in oil prices a bit here, quite a bit higher still than what we used last year. And our market cap is about 52 million US. These are all US numbers here. So that's one metric where our valuation is quite cheap from our point of view, with a $72 million market cap for on the Canadian side of things.
I should have pointed out that you guys do report in US dollars. So most of the numbers are US, but there'll be a few Canadian within the presentation.
Yeah, that's a good point, Jess. So we are in Oklahoma, our main project here, which is the Tishomingo field. And you'll see we're down in the lower part of the scoop for those that follow Oklahoma. And you'll see the purple all around us, and that's Exxon. So we have got about 17,000 acres in the middle of Exxon. Exxon had been buying up acreage back in 2010, 11, 12, and then through 13. They were buying the Woodford, which is what we developed originally out here. We drilled about 40 wells in the Woodford shale to find this acreage, start proving it up. And we were the last holdout to sell to Exxon. So we ended up selling our Woodford rights, excuse me, for about $147 million. And we kept a hold of the slightly shallower Caney formation, which we saw was much oilier and had good potential to go forward. So we held on to that. We're one of the only companies, actually the only company that held on to that while they were buying everything else. And so that was our focus. The Woodford is about 80% natural gas, whereas now, as I mentioned, the Caney is about 80% oil. Moving forward, stock price chart, you can see market cap that I talked about already. And then the forecast for the year, 2,700 BOE a day exit rate, adjusted funds flow / adjusted EBITDA, pretty close to the same. It's about 26 million is what we're projecting. And our debt to EBITDA should be less than 1. So our debt is going to stay about the same. We're at about 16 million in debt with Bank of Oklahoma. We do have a $25 million line of credit with Bank of Oklahoma that just got increased to 25 million here in the last couple of weeks. And that's why our debt to EBITDA is looking so good going forward. So moving forward, what we have here is the projection of what these wells are going to perform as. As I mentioned, Netherland Sewell will be doing our reservoir engineering, or has been doing our reservoir engineering, excuse me. What they consider their PUD case decline curve IPs at around 400 BOE a day, and is the average of a lot of the wells that we've drilled out here in the Caney. We have put together our own type curve, which is what we call the KEI 1231 type curve. So it doesn't include the wells we've drilled this year, but it's a little bit higher. And what it is takes these 7 wells that we consider our corridor or acreage. A couple of them had shorter laterals where we just normalize it to a full length 1 mile lateral, and takes the average of what these wells have performed. And that's what comes up with this red line here on the corridor type curve. There's also the possible curve, and this was back from 2017 that Netherland Sewell had put together this type curve here on the possible side of things. And the reason that I put that up there is because our first 2 wells this year, one was the Barnes 7-3H, which came on for just under 1,000 BOE a day, and the Barnes 8-4 that came on right around 600 BOE a day. So obviously quite a bit higher than what our previous wells were making, and what we were estimating as well on a conservative basis. So the Barnes 7-3H and 8-4 IP rates are more precisely 2.5 and 1.5 times higher than the PUD report numbers that Netherlands Oil was using. And just looking at the internal rates of return up here on the PUD basis or the type curve basis at an $80 and $90 oil price, we're making excellent IRRs. Now, I will qualify that these were at slightly lower prices for capital for drilling, but given that we're outperforming these wells, we feel comfortable that these are the kind of rates of return that we can still continue to make, assuming we can keep making wells that are performing up in this upper range here. What we're looking for is hopeful that our wells will continue to perform along the Barnes 8-4. It'd be great if they all did 7-3, mind you, but not what we're counting on. Also, all our forecasts are based on our red line still, which is our more conservative case in this case for our type curve going forward. Decline curve comparison, as we just covered, similar rates here, same numbers for the proved, for the KEI curve, and then the possible curve. But what I'd like to point out is, if you look at the EURs out here, the ultimate ultimate recoveries here on a BOE basis, over the years, it's been getting better and better and better. So Netherlands Oil has been acknowledging that this is a good reservoir. It's been improving, and we've been making better and better wells, and the wells just keep getting better every year as we go forward. So those are the numbers that they're assigning. So on the PUD basis, 555,000 BOEs. And I like to point out this red line here is our Glen well, our Glen 16-2. That well will end up recovering over 750,000 BOE a day. So assuming we can make their next 3 wells, which are drilling right now, by the way, we're in the process of drilling, and then we'll be fracture stimulating all 3 of these wells coming near the end of this month and in November. So they'll be coming on production sometime in November and December. But if we can keep making wells that are above our the PUD case from Netherlands Oil and hopefully above even our type curve, then we would expect these PUD numbers to go up more from Netherlands Oil by the end of the year, and thus our proved reserves should increase even further, even though we have 34 million of BOEs in proved reserves right now. Drilling location, this is again from Netherlands Oil. This is on the 17,000 acres. It's almost all held by production because of that deeper Woodford that I talked about earlier that we drilled wells in and held it. And XTO has drilled additional wells in the Woodford as well. There are 185 additional booked locations. This was at the end of last year. This is at 6 wells per section. And these are all Netherlands Oil's well locations for us. So the green here are the PUD locations. And as you can tell, most of those are in the corridor that we're talking about, where we think we can make great wells. Infrastructure is all in place. We have a full 3D seismic out here that we've shot and then even reprocessed for the Caney. But all our gathering systems in place. When we had sold our Woodford acreage to Exxon, we had sold them our 1/3 of the gathering system that we had at the time. They'd acquired 2/3 from other operators out here. And so now all of our oil gets trucked out of here. So it's a $1.85 less WTI pricing that we get for our oil. And on the gas and natural gas liquids, Exxon markets that for us. So we just pay a gathering and a compression fee to Exxon. And we're within a half mile to a mile of all gathering systems out here. So there's not a big cost to drill out, to build out a gathering system. And then what Netherlands Oil had evaluated was this area. So we still have this area off to the southeast that we think at some point in time we can pursue to see if we can make economic wells out here. But right now, our focus is going to be just in this corridor region, low risk drilling and increasing cash flow. So there's additional upside here. Not that we don't have enough to keep us busy for a while, but we've got the False Caney, which is up top here. That is about over half our acreage or so. That looks excellent on logs. We have not tested it yet. All our reserves are booked from the Caney. And then we have a number of wells that we drilled into the T-zone that we call down here. That is also additional potential that's not booked right now that we can go for in the future. So undervalued, as I mentioned. So the green is our KEI here. And sorry, that's a typo on my part. The comp should not be green here on number 6. But this one here is 13% of where these other wells are, or these other companies are. So you can see that from our evaluation from the reserve report from the end of last year, and we were trading here, we should be 3 to 4 times, in our opinion, higher trading than where we are right now. Same on, that was on the proved side of things. This is on the proved and probable. Same kind of metrics. We should be, 3 to 4 times higher, in our opinion, again, on a stock valuation basis, based on our proved and then our proved probable basis. Year-end reserves, just to put in perspectives, we're trading probably around 210 this morning. I've been busy, so I don't know exactly where we're at, but in that range. We have our year-end reserve report would value us on a proved basis of $13 a share, and this is Canadian dollars. 2P would be up in the $18 range. And then our operating netbacks. So we've taken a look and said, okay, so why are we undervalued? Is it our netbacks? And our netbacks are higher than the peers that we've selected here to go forward. So that's not it. Our G&A has been coming down year after year, as you can see. And then our OPEX per barrel of oil equivalent is also down in the low end. So these three comparison peers here are actually all natural gas producers. And on the US basis, for those of you that are in the US that aren't used to having royalties in there, our OPEX is about $7.77 is for lifting costs, et cetera, and field operating expenses. Just so you can keep that in perspective, because the US people look at this and go, what's $26? They're not used to seeing the royalties in there. So how do we remedy this? How do we remedy this undervalued situation that we have? We increase capital. So we did a rights offering in the last year where our bank was also supportive of it. If we'd raised $5 million, bank was going to kick in another $2 million. We raised the $5 million thanks to a number of shareholders that participated in that, and we were able to start drilling wells. And as I mentioned, we drilled the 2 wells earlier this year. Luckily, oil prices have cooperated nicely, because when we put the rights offering together, oil was $65, and it still made sense to do this at $65. But oil was over 100 when we brought these wells on, so that added nicely to the cash flow. And the most important part is that they drastically outperformed what we were expecting or what we were projecting. So what we were hoping for, great, but great that they outperformed. So we look forward to continuing to drill. So we're drilling 3 wells based off of cash flow. We do have the available line of credit as well, which is very helpful in that in this market environment, it's sometimes hard to get casings and things like that. So we're able to buy casing in advance to make sure that we have it when we're drilling our wells going forward. So our goal is to continue to execute and deliver great wells safely. As we mentioned before, our debt has been reduced from 30 million down to 16 million, and our year end is somewhere in the 15 to 17 million range is what we're projecting. And the increased cash flow as it grows should maximize shareholder returns. And as you know from this webinar, we're also working with Adelaide here in order to get some more market awareness to us, because frankly, for not drilling for 3 years, people kind of forgot about us. So we put together something just to show a little bit of what just this one project can do. So we put together and said, okay, we'll drill some wells. We're drilling wells right now. What if we get production up to 3,000 BOE a day, let's say, and then hold it there? So what does it take to get it there? What does it take to hold it there? And then what does it do for us? And so as you can see from this cash flow here, this theoretical version, we spend the CapEx in the next couple of years. We're paying down debt. So we would be debt-free in this hypothetical situation by the end of 2024. And then we have free cash flow of $35 to $38 million a year, which is over $1 share US on average from our company, because we have 35 million shares outstanding. So what does it take to do that? So this assumes the 5 wells we're drilling this year in 2022, assumes 6 wells drilling in 2023. Production-wise, we're assuming that it's our type curve, so not anything better than that, not how these wells have performed. So we think we're being conservative on that fashion. We are using $90 oil, so it's slightly higher than where we are today, but not hugely so. And then you can see in 2024 and 2025, I'm looking at the wrong chart here for you guys, but I'm circling. We have 1 well in 2024 and 3 in 2025. So an average of 2 wells a year should hold us around 3,000 BOE a day to get that cash flow of call it 35 to 38 million a year. Just as a reminder, we have 60 proved locations out here at the beginning of this year. So if we were just looking to hold production here at 3,000 BOE a day, 2 wells a year, we've got a lot of runway to get things going. Now, what are we going to do with that? If we get to those numbers, we can decide as a board as far as, do we continue drilling, drill more wells, get cash flow up higher? Do we use that cash flow for other acquisitions that are accretive, because we do have our eye on a couple of other things that we'd like to do? Or do we start paying dividends or do share buybacks? Those are all options. And that's what we look at this. We said, look, we can get this going. We can drill these wells based on cash flow, so we don't need any additional money right now. And we can just grow the company, and that gives us options. And having optionality is always a good thing. So that's really the gist of it. I kind of covered most of that in the last one. Why Kolibri? Excellent asset, low debt, lots of years of drilling inventory, have a highly experienced team. Our cash flow is going up. We've got everything in place from a strong governance point of view with KPMG and NSAI. And we're in the middle of drilling our wells and about to have a bunch of news flow coming out. And fingers crossed that they perform like these last wells, which we have high confidence in, given where we're drilling, and given that all this rock should look very similar to each other. And so on top of that, we should have proved reserves that hopefully will increase even further when Netherland Sewell does our year-end reserve report. So with that, I will, that's the end of the presentation part of it, but we'll open up to questions, etc., or whatever Jessica wants to do.
Oh, thanks, Wolf. The story sounds phenomenal, as we've discussed before. Can you give us an idea of your current production? Are you willing to do that?
You know what? I don't think we can say that on here just because we haven't announced it. So we were at 1,900 at the end of second quarter, and I'd like to stay on board with the regulators. So there are natural declines. Obviously, that goes forward. So the main thing I can say is that we're still projecting to be around 2,700 BOE a day at the end of the year, assuming these we can get these wells on production as we still plan to.
Okay. And decline rates you're seeing on the newer wells you've drilled, are you willing to talk about those, or are you going to wait till your quarter?
I will wait till that too. I do have on this slide deck, I think, we do have a couple more months that we threw up on here, where you can see here that they're following these decline curves quite well. So we're quite happy with how they're performing so far.
Okay. And I mean, they've been on since March, most of them. So you're getting you've got some good data.
Exactly. We're getting reliable, and generally, you can tell on these wells if they're matching the decline curves pretty well, pretty early. So it looks like we're right on track with what we were hoping they would do.
And so, and you said that your liquids ratio is about 80%. Do you see that as the wells continue to produce? And I want to compare your new completion techniques to your older wells. Do you see the GOR increasing as they've been, or have they been made? It's been pretty flat.
And so the wells, don't tend to. We get some amount, and like you said, in the gassier areas, we had a little bit more gas, and the gas increased a little bit more. But in this side of the field where we're drilling, we have not seen significant increases over time in our gas numbers. So it'll be a slight amount no matter what, but nothing significant that we've seen so far. Okay,
good. So do you believe how you've drilled a lot of your acreage, but yet you still have a little bit to drill out, as you said, to the eastern side. But do you feel you're fairly fully delineated on what you have at the moment?
Yeah, what we're going to be doing here for the foreseeable future is just in this region here that you can see on this page here that I'm highlighting. Mm-hmm. So we're going to stay in here. These are the wells that are actually a little gassier. This is enough to run a horse block, where some of the Woodford that I was talking about is about 350 feet below us. That's much gassier. Looks like it has leaked up into the Caney here. But we think out here that'll get a little oilier again. So I think we'll able to change some more of these locations out here into PUD locations that look comparable to what's going on here. And then, as you said, as we go to the east, it's a little shallower. It'll take a little different completion techniques, but that's for the future for us to figure out.
Okay. And do you think that your new completion technique is repeatable across your land base? And do you expect much variability there, or no?
No, we don't. Not when we stay in this corridor region here. The rock is all quite similar from what we can see from all these wells. And as you mentioned, from our early Woodford wells, we had to drill through the Caney. So we had 40 plus wells view. That we have a good feel for what's going on geologically. Don't see a lot of differences. Little structure in the areas, but that's about it.
Okay. Given some of the audience may not be as familiar with Oklahoma, can you provide color on how Oklahoma is as far as a jurisdiction for oil and gas, and what it looks like for services and costs, etc.?
Sure, happy to. Yeah, Oklahoma's always been quite oil and gas friendly, so it's a lot easier of a jurisdiction to work in than many other states across the U.S. And I'm glad we're not drilling these wells in California when we started that. Oklahoma, we can get permits quite quickly. They're willing to work with you. They have what's called forced pooling. So they encourage the drilling so that one royalty owner can't hold out, because these are all private minerals. So there's no federal lands here. So the government, when you hear about the U.S. Not wanting to lease things or not wanting to grant permits, that doesn't affect us because we're on private land here. And the forced pooling allows drilling to go forward in order to pool a full section of land. Whereas in Texas, you might not be able to pool a full section of land. So it's really a great jurisdiction in order to operate in. As far as equipment goes, we're about halfway between Oklahoma City and Dallas. And so we've always been able to pull equipment in from multiple different areas because we're kind of in the middle between them. And so we have not had a huge problem with trying to get equipment, whether it's drilling rigs or frac stimulation equipment. We've got good relationships with a number of people on both sides of those things, and it's worked out well for us.
And any significant cost creep, or the fact that you're utilizing rigs between them being used by larger producers, they're giving you a pretty decent deal?
So the costs have definitely gone up. I mean, casing has gone through the roof. I mentioned earlier, I think that, casing is hard to get. So casing prices were 2 to 3 times higher than where they were, which was a big hit. Rates have gone up on numerous different things. Our wells that were 5.2 million are more like 6.9 now. We think we're holding it in that range. But yeah, costs have definitely gone up, but hopefully they're holding around steady now and not creeping any further.
Yeah, I think they've pretty much steadied out from what I could determine for most producers. With your disposition with Exxon, you talked about keeping the uphole formations uphole for. Now you haven't explored any of the other parts of the Caney Shale. When do you anticipate doing that, or is that further down the road?
I think it's further down the road. Our goal right now is to increase our cash flow, keeping risk down low. We have got a lot of drilling locations around us here in the core that we can go do. And I think that's the most important thing right now, is to spend money wisely, low risk, hopefully high return, keep doing what we did on the first 2 wells, and show that we can increase cash flow and get the valuation of the stock up higher in that process, not take unnecessarily risk. And when you're when you have a lot of cash flow, then it's okay to spend a little money to keep going. But we've got a lot of inventory here we can drill before we start looking at those.
Now, you just had one of the questions from the audience here. How frequent are your boring bases? Is your boring base being redetermined? They're hearing that some lenders are going from quarterly to monthly.
Wow.
And you just had yours increased. So
Yeah, so we're every 6 months, so twice a year.
Okay, that's pretty standard. Yeah. So as far as your 2023 plan goes, so you'll have wells being fracked and completed into the end of this year, and some results. When do you? How do you see the next 6 wells being drilled for next year as far as timing goes?
So 3 will. So this is non-board approved. So this is just management opinion at this point. So let me make that clear, because we haven't put our formal budget together for the year yet. But we want to start off with 3 wells in the first quarter, and then proceed from there. We'll see what energy prices are doing and be able to forecast a little better as far as timing for the next ones. But our goal is kind of to use cash flow. We can lean on debt a little bit, but we don't want to drastically increase debt either. And then we'll see how many we can start drilling in second quarter and then beyond there. So as we just start drilling, these wells come on production. If they're coming on production at higher rates, obviously, than our KEI type curve that we've been using, then there's more cash flow and we can speed up the drilling of those as well. So it's a bit of a work in progress, I'll say, as the year will go on, but we'll put a budget together that we'll announce as well and put a forecast together later on.
Okay. And then let's see, someone wants to commend you on how well you've done on your new type curve.
Thank you.
And has your reserve advisor accepted a type curve? And do you think the best reserve Netherlands Sol is the best reserve for evaluators to stick with?
We've been happy with Netherlands Sol and what they've been doing. I think they're fair in what they do, and I think they aren't. I think they're on the conservative side of things, but that keeps people out of trouble too. I think they have a good reputation, not really looking to change from that as well. And as far as what the type curve will be like from them, we'll just have to see what it looks like at the end of the year, more like in February, March of next year. We'll start working with them toward the end of the year and in January, February. Okay. So we'll see where we're at, but they're going to want to see as much data as possible from these next 3 wells too, in order to increase those, or where they increase it to.
Okay. So let's see here. One person asking, what's your tax pool situation like? And how long will you be shielded from paying corporate taxes at 3,000 BOEs a day?
Answer that one. So we have a current NOL of about $190 million. So, and that expires from 2029, I think, to 2041. So we have many years of tax-free income to make. I mean, I haven't detailed the number of years, but it's a significant amount. So there's no short-term tax issues related to that.
Okay. That's good because a lot of the guys are facing taxability here, which except for the large ones, never really saw with the smaller producers, considering their historical spend. Now, there are a lot of larger producers in the area. Any of them drilling the Caney, or are you guys the only one?
So the Caney is a little unique in where we're drilling it. I mean, the Caney is the equivalent of the Merrimack. But the Caney around where we are and where Exxon is a little different animal than as you go further to the north. So we're a bit unique in that it's a really high net to gross shale. So we don't have a lot of high permeability sand streaks and things like that. Mm-hmm. That's why in the past our IPs have not had these, headline large IPs, but also the advantage that we have is that it doesn't have the hard declines on it. And that's why the EURs kept going up year after year after year, because our declines were less steep than Netherlands Sol was assuming over the years. So we're a little different animal than what they're doing a little further to the north and northwest of us. Okay.
So as far as acquisitions go, do you think there's some prospective land or smaller companies, mom and pops in your area that you would be interested in? Obviously, you wouldn't want to use stock, given your low valuation, but with an increase in your bank line, would there be an opportunity for acquisitions?
We're looking at a number of things. The acquisitions what we're looking at right now are potential targets and potential ideas that we have, I should say, take a little bit more money than what our line of credit has in place. So I think timing wise, we're not quite there yet. I'd like to get the stock up higher and get more cash flow built up so we can get a little bit more debt as well, or potentially use equity. But as you said, it's not even in the ballpark where we are now as far as equity goes using that. So it handicaps us a little bit.
Yeah, well, you're not alone there. And then hedging. How do you your current hedging program?
We do hedge for Bank of Oklahoma does require us to hedge. They keep us a rolling hedge for 2 years for 75% of our oil portion of our PDP. So as new wells come on, those are unhedged, and then we have to eventually catch up once they do a reserve report on what those numbers are going to be. So Gary can talk to what we have right now if you'd like.
Yeah, sure. So as far as what we have currently on the hedge books, we have for the fourth quarter, we have about 530 barrels a day hedged at $74. For next year, we have just under 400 barrels hedged at an average price of $68.50. And then we have started getting into doing costless collars to give us some upside potential on price. So we have about 130 barrels at a costless collar range of $70 to $94. And then 2024, for the first 5 months of the year, we have about 110 barrels hedged at $62.77. Those are old hedges we entered into a while back. And then we have from June to September, we have about 425 barrels at a costless collar between $60 and $82. That's our current hedge book now.
And if you look at this graph for our illustrated purpose, that's still a small percentage of what our overall production hopefully will end up being from a hedging point of view. But that's what keeps the banks happy. And some of those older numbers where the numbers were lower were old hedges that we had in place or had to put in place while oil was down low to keep our line of credit in place with the bank. So
okay. But I mean, as long as you're protecting their CapEx, I mean, really, that's sort of what you need to do, right?
Yep.
Now, this person's asking, would you look for lending alternatives to the bank? I mean, if your bank seems to be working with you, as opposed to the Canadian banks that work against the producers now, I don't know why you would want to find more expensive debt, but I mean, maybe you could do some term debt that's reasonable. Have you explored that?
You know what? Right now, we've been okay with Bank of Oklahoma. We've been happy with what they've been doing. They worked with us through the downturn as well, when we were paying down debt, etc. And they have increased their line, and I would anticipate that these 3 wells come on as we expect them to, that our line will go up even further. So I don't see, like you said, spending a lot of money getting some high cost debt, because I don't know that it'll really make sense for us. If we had an acquisition that we just couldn't live without, and we'd want to do that with debt, we'd have to carefully think about how much debt we'd wanted to take on in the first place and how expensive that would be.
Okay. And now this person is, related to your hedges. They think the 75% is rather high and doesn't allow for as much flexibility. Again, so this is, on the back of the other person's question as well.
Mm-hmm.
How easy would it be for you to change banks? But you just said you've been pretty happy with Bank of Oklahoma, and
I'm also hoping that as production comes up, unless we are drastically increasing our line of credit, we can have some flexibility in that as well. I understand where they're coming from here as we were coming out of the downturn, drilling wells, having that in place, but hopefully in the future we can knock that percentage down as well. But first we need to have that cash flow coming on.
Yeah. So again, you didn't drill for 3 years, so Yeah. So once they get more comfortable, and what do you think? I mean, we often use syndicates up here. Is that a common practice for smaller producers in the U.S. or no?
It just depends on the banks. So yeah, I mean, syndicates are, in the U.S. as much as in Canada as well. Right now, we're 100% with Bank of Oklahoma. They have the ability to syndicate this. It's in our documents, but right now it's just them.
Okay. And then what's your, it is suboptimal to have almost non-existent net debt, which I think we all agree on. It's an inefficient use of capital. What would be your ideal, and what would your lender be agreeable to as far as your debt to cash flow ratio?
I think our documents say, what is it, 3-to-1, Gary, is what we need to stay below. I like keeping debt down lower than that. I think that debt should be used for, yes, you can push it up to that level, but you have to show a fashion of getting it back down again fairly quickly. So I think you can peak out at something that's higher than a 1-to-1, but you want to see it start coming back down that way too, just to have a good, strong balance sheet.
And just to add, the non-existent net debt was just an illustrative example. I mean, that just to show the cash flow we can generate after paying off the debt. So that doesn't mean we're going to do that. That was just
correct.
Okay. And then how has downspacing been achieved and represented in your type curve? I think it somewhat has.
Did you say spacing?
Just your downspacing. You haven't drilled to the 6 wells per section that you had forecast that you can do, and maybe
right.
more. So I don't, and represented in the type curve. So I guess we'll have a better idea. You said you could maybe go to 8 wells per section, but you're not sure yet.
Correct. Yeah, we're going to do some more work this year, just based on the fact that how well these wells are performing now. We'll do some reservoir work in the fourth quarter here and early next year, and then work through that with Neville and Sewell as well, as far as if we stay at 6 wells or go to 8 wells per section.
And so
we do have a couple of wells that were drilled on tighter spacing. So out in the field, and there's not full development of it, but we kind of have an idea of what's going on. And so far, no, there wasn't a big impact between the two.
Okay.
So,
but with the amount of wells you have to drill, you don't really need to start downspacing yet, really. No. Okay. And then, have there been any recent acreage transactions in the neighborhood? If so, what's been the price per acre?
Yeah, no, not that we've seen.
Okay. Let's see here. And then the other questions I had, we've talked about acquisitions, we've talked about increased reserves. And I think, you pointed to the fact that, your high PUD to PDP ratio is one of the reasons why you're trading at a discount. I would also hazard a guess that, you haven't been out with any exposure. You don't have coverage at this current time by any analysts. So it's sort of like an old story that's a new story that's been restructured and starting again. So this should be a year where you start to get a lot more attention.
I would agree with that.
Yeah. And one last question for me: if you had unlimited funds, how would you change your development plans?
I think we'd speed up the drilling out here if we had unlimited funds and didn't have to worry about that. And then also we would test some of those other intervals that we just spoke about. And in addition, look at some of these other targets that we're looking at to see if we can make those happen at the same time.
Okay. And if you could elaborate on the relationship with Exxon, have you, beyond the NGL gathering and marketing, is there any other relationship you have with them?
No, they did drill one well out here that we had a lot of meetings with them beforehand and went through with them as far as how we do things and why we do things that way. And then they drilled the well how they wanted to drill it. So,
Well, they're Exxon. They do what they want.
that's it.
Yeah.
All nice people, but they ended up doing something totally different than how we would do it. So
Yeah.
it is what it is.
Well, congratulations on your success this year. It's been phenomenal, and we're happy to be working with you. And there doesn't seem to be any other questions. And I think we've covered everything, unless you think I've missed something.
No, I mean, that's like I started out with. It's a pretty simple story. So it's pretty straightforward, I think. And I'm happy to answer the questions that everyone was asking. I appreciate everyone's time that they spent on this. Yeah.
And if anyone needs a one-on-one with the company or has further information they require, you can email me at jessica@adcap.ca. And I thank you both for your time this afternoon.
Well, thank you. Appreciate it.
Thanks. Okay. Take care.